Generally talking to builders, they have good pipelines really for the balance of this financial year, which is very encouraging. The stimulus has worked very well. Maybe it was priced a little bit under Sydney. I'd say maybe it just didn't quite engage at Sydney, but definitely regional areas of New South Wales and the rest of the country are just strongly engaged. The builders in Melbourne were very lucky to get that little window between the lockdowns, and they wrote extraordinary numbers in that period of time. However, with the lockdown now, it's virtually impossible for potential home buyers to go and visit a display home or to sign a contract, although a number of them are signing contracts online and a number of them are buying houses unseen. I would tend to think that apartments might be a little bit soft going forward, particularly in the cities. Lack of students, lack of people that we hear from overseas, working on working holidays, etc. When I look at North America, it's there. We see a lot of the same sort of trends as what we're seeing in Australia. People are moving out of the cities to regional areas because they realise they can work anywhere. So I would tend to think that demand for apartment buildings is a little bit softer. The non-residential work we're involved in has been slowed down, delayed, deferred, as I mentioned. And so generally we're sort of seeing that the non-residential work's down about 20-25%, but the residential area has increased strongly, and in some areas it's up as much as 100%. So this is, between all that, as you know, we've got about 2/3 of our businesses in the non-res area and medium density, but there's obviously going to be a bit of a shift underway there. But Brickworks is in good position. We've got a portfolio of attractive assets, strong balance sheet, and we've got the resilience to see this through, and I'm very confident we'll come out the other side a much stronger company for the experience. So thank you, and I'll hand over to Todd if you're going to take over.
Thank you, Lindsay, and good afternoon, ladies and gentlemen. Firstly, I want to welcome the 9,000 shareholders who joined our register during the year. Our shareholder numbers grew by 45% in FY20, and we're just shy of 30,000 today. Because we have so many new shareholders, it's always useful to start with an outline of our business strategy and objectives. WHSP has a diversified portfolio of uncorrelated assets across a number of asset classes. Our open mandate allows us to switch between asset classes depending on our view of what represents the best risk-adjusted returns for the forecast period. By taking a long-term view, we can be contrarian and allow our themes to develop over time, and we can also invest in the growth of our investments. We aim to be a trusted and supportive capital partner for our investee companies and assist them through their journey of growth. We have quite a small team of talented executives to execute on this investment strategy, and the management team is supported by a very experienced board of directors led by Rob Milner as chairman. In July, we were fortunate to have Josephine Sukkar agree to join the board. Josephine is an experienced entrepreneur and business executive, having founded the Buildcorp construction business over 30 years ago. More recently, Josephine has served on a number of public, industry and government boards, on top of contributions to various not-for-profit and charitable institutions. There's a very good mix of skills and experience on the board, and this is a great asset for the company. The group regular profit for the year was $170 million, down 45% on the FY19 result. However, statutory profit was up 284% to $953 million, due to the large non-regular accounting gain from the revaluation of our shareholding in TPG following its merger with Vodafone. However, we don't believe that profit figures are a good indicator of our success. What we focus on is the same thing that any investor focuses on with their portfolio. Firstly, we aim to grow the value of capital, and while the portfolio reduced by 5.3% through the year, that represents an outperformance of 6.9% compared to the market, which suffered a significant correction. And secondly, we aim to improve the yield we receive so that we can pass on that yield to our shareholders. And we measure this by looking at the cash we receive from our investments, and this was up 49% for the year. The cash generation was robust across the business, notwithstanding a difficult environment where many companies in the market cut dividends, and we were assisted by a significant special dividend from TPG prior to the implementation of the merger with Vodafone. The directors have resolved to pay a fully franked final dividend of 35 cents per share. This brings total dividends for the year to 60 cents, an increase of 3.4%. The All Ordinaries Index comprises the top 500 companies on the ASX. WHSP is now the only company in the All Ords to have increased its dividend every year for the last 20 years. In fact, there's only 5 companies who have achieved this consistent growth for more than 10 years. We're extremely proud of the fact that the company has never missed paying a dividend since listing in 1903. And more recently, through difficult periods such as the GFC and COVID-19, we've been able to continue to grow the dividend paid to our shareholders. Over the past 20 years, the interim dividend has grown at a 9.2% compound annual growth rate. As I mentioned, for the year ended 31 July 2020, the gross value of the portfolio before tax was 5.3% lower at $5.2 billion. This compares very favourably to the performance of the market, where the All Ordinaries Index fell by 12.2% through that period. This generated an outperformance of 6.9%. And while we saw a strong performance from our investment in TPG, this was offset by poor investment returns from New Hope. There was a significant uplift in the borrowings during the period, which have mostly been placed into liquid assets to provide us with the capital to take advantage of any new opportunities that we expect will present themselves through this period of dislocation. This slide shows the annualised TSRs for WHSP shareholders for various periods and compares them to the ASX All Ordinaries Accumulation Index, which also includes the reinvestment of dividends. The TSR performance has been strong over the period shown above, with the exception of the 1 year period. While the share price underperformed the market for the last 12 months, as I said on the previous slide, this does not reflect the fact that the underlying value of the portfolio outperformed the market by 6.9%. As a long-term investor, our focus is on delivering outperformance over the long term. We are proud of the 5.2% annual TSR outperformance against the market every year for the last 20 years. And this outperformance has had a material impact on shareholder returns. Over that 20-year period, an investment in WHSP has appreciated nearly 10 times, which is over 3 times greater than an investment that's performed in line with the market. And this performance has been maintained for a long period of time. If a shareholder had invested $1,000 in WHSP in 1980 and reinvested all of the dividends, the shareholding would today be worth over $155,000. This equates to a compound annual growth rate of 13.5% year on year for 40 years. And this growth does not include the value of the franking credits which have been passed on to shareholders along the way. In this section, I'll look at how our business is dealing with COVID-19. When the outbreak of COVID-19 hit and was subsequently declared a global pandemic, our first priority was to ensure the health and safety of our workforce, as well as playing our part to control the spread of the virus. Our next priority was to ensure that the business could maintain continuous operations, as well as operate productively and effectively. As a small team with a diverse portfolio, we rely on daily interactions to monitor our existing investments and progress new investments. We were able to do this effectively through the COVID-19 affected period. Our business is very resilient to these kinds of events. We have in place the policies, procedures, technology and culture to be able to adjust, adapt and thrive. The parent company, WHSP, did not apply for any government assistance. A couple of our investments were affected and received a small amount of JobKeeper assistance, though they did not pay any dividends. Our cash generation was not supported by government subsidies. We supported all of our businesses who were impacted by COVID-19 through this challenging time. We also did not seek rent relief, and nor did we reduce our workforce. While our business operations are resilient, the economic environment is volatile and uncertain. During the last 6 months, we've experienced a number of shocks, any one of which would have been a major event on its own. We saw major global market corrections, oil prices and other commodities collapse, entire industries shut down for months, mountains of government stimulus and massive increases to government debt. The Australian dollar fell over 20% and then recovered higher than where it was pre-COVID-19. The US Federal Reserve is providing a deluge of dollars for its own economy through massive and open-ended purchases of bonds, and has provided liquidity swaps with other central banks, meaning the world is drowning in US dollars. On top of that, the recent announcement by the US Federal Reserve indicates a willingness to allow higher inflation and a commitment to low or negative real interest rates. And these will continue to weigh on the US dollar. The biggest impact on our portfolio from an Australian dollar perspective is the price that New Hope receives for its coal. Brickworks North American earnings are also affected, and our commodity exposure in Round Oak is also impacted. However, you can see that the commodity price graph on this slide shows that the strength of the Australian dollar in recent months has been overtaken by the increase in the price of copper. So in Australian dollar terms, copper is now above where it was a year ago and continues to have a positive outlook. Coal, on the other hand, has fallen over 30% in Australian dollar terms since March 2020. While we considered TPG to be a consumer staple, which would be less impacted by a downturn, Vodafone has suffered from lost revenue from inbound travellers buying prepaid cards and less roaming margin from inbound and outbound travellers. The latest IMF data predicts a bounce back to global economic growth in 2021. However, the outlook, in our opinion, is still uncertain and we are cautious. A lot depends on the ability to control further outbreaks, the timing and effectiveness of a vaccine, and the geopolitics and the trends toward deglobalisation, and our responses to all of those challenges. We are treading carefully, but we do believe dislocation brings opportunity, and we have liquidity to take advantage of good opportunities. Since the start of our second half, on February 1 this year, WHSP's share price has been very resilient. At the nadir of the market correction in March, the All Ordinaries fell 2.5 times greater than WHSP's share price, and that strong performance has continued. For the period from 1 February to close of trade yesterday, WHSP's share price is up 9%, while the All Ordinaries is down 14.2%, an outperformance of 23.2%. Looking back over the last 20 of our financial years ended 31 July 2020, the All Ordinaries has been negative in 5 of those years. And in 4 out of the 5 years, WHSP's total shareholder return was actually positive, with an average outperformance of 13.5% per annum. So it's not new that WHSP has a portfolio of assets that tend to be very resilient in difficult conditions. Now, looking at our major investments, our investment in TPG was split into 2 companies with the demerger of Tuas. We also received a $121 million special dividend in July. The merger of TPG and Vodafone occurred during the period to create the merged TPG group. The merger of equals created a near $15 billion market cap company as at 31 July, and WHSP owns 12.6% of the enlarged entity. Consequently, TPG is no longer an associate, and this triggered a one-off accounting gain of over $1 billion after tax, as we uplifted our investment to market. Both of these companies now are in our telecommunications portfolio, which increased in value by 27.6% during the year after adding back the cash special dividend we received. And while the special dividend of $121 million was received in FY20, the WHSP board has allocated the special dividend notionally across the FY20 and FY21 years to more accurately represent normal dividend payments from TPG. In FY18, the TPG dividend was cut to preserve cash for its proposed mobile network rollout. TPG subsequently abandoned its plans for a mobile network and was able to return the cash to shareholders just prior to the merger in July 2020. Of the total dividend, an amount of $92 million was allocated to FY20 as a catch-up on previous 3 years of depressed dividends, and the remaining $29 million was allocated to FY21 to account for the fact that the merged TPG changed its year-end and announced it would not be paying a dividend in the second half of calendar year 2020. This will result in WHSP receiving only one ordinary dividend from TPG in FY21, which will be the final FY20 dividend in around March next year. TPG shareholders also receive shares in Tuas via an in-specie dividend. WHSP owns 25.3% of Tuas, which is the company containing TPG's mobile business in Singapore. This company is significantly advanced in the rollout of its mobile network and has commenced offering services to customers. Tuas will be a disruptor in the Singapore mobile market, able to offer significantly cheaper products than the incumbent operators who have legacy networks and higher overheads. Tuas's assets, being the network infrastructure, spectrum and cash, are in excess of the current market capitalisation of that business. The merged TPG group has a 31 December year end, so the last result we have is the first half ended 30 June. That result had only 4 days of contribution from the TPG business and were therefore predominantly the Vodafone Hutchison Australia results. The old standalone TPG did give some update on its performance for the 11 months to June 2020, and it generated $720 million of EBITDA, which implies a 12-month result in line with the upper end of its guidance. Continued migration of customers to the NBN impacted EBITDA by $48 million. However, that was partly offset by $31 million from other growth in corporate, cost savings and fibre to the building products. We expect the NBN migration will have largely played out over the next year or so. Vodafone's underlying EBITDA was down 8%, predominantly on COVID-19 related impacts. These included an 80% reduction in margins from roaming, both inbound and outbound, lower prepaid plans from international visitors, inability to onboard new customers due to contact centres in India being closed and retail store closures in Australia, and financial hardship offers and extra data, free calls and the suspension of late fees during the COVID crisis. We're excited about the opportunity for the merged business to be able to achieve significant cost reduction, offer bundled services and aggressively win market share. There's no need for me to go into detail about Brickworks' performance, given we've just heard from Lindsay, but my only comment is that we believe our investment is well supported by the assets of the company, and the cash generated from each of those investments, particularly the WHSP dividend and the rental income from Industrial Property Trust, go a long way to underpinning the Brickworks dividend going forward. And Brickworks, as Lindsay pointed out, has a stellar dividend history without any cuts since 1975. New Hope's financial performance for the first half of financial year 20 was solid, recording a profit before tax and non-regular items of $124 million. However, the second half result was greatly impacted by the COVID-19 pandemic, and the full year profit before tax and non-regular items was $120 million. Production at Bengala was up on the previous year. However, those volumes were partly offset by falling production at New Auckland, as the mine is running short of coal without the approval of Stage 3. New Hope remains committed to getting those approvals, however continues to battle lawfare tactics by environmental groups and inaction by the state government. Cash generated from operations before CapEx, tax and interest was approximately $300 million. That's down from the $500 million in FY19, however shows that this business is highly cash generative. New Hope's gearing ratio is 14% and has an additional $150 million of headroom to draw down further cash under its existing facilities. New Hope did not declare a final dividend due to the uncertain economic outlook and the funding of important maintenance on the Bengala dragline. COVID-19 has had a significant impact on global coal markets. Energy demand globally was down 4.5% year on year. However, coal consumption was down 22%. This is a result of other sources of energy becoming cheaper, such as gas, and renewables having low marginal costs once the CapEx has been spent. Strong recovery in the Australian dollar relative to the US dollar to levels higher than pre-COVID-19 is acting as an additional negative drag on coal revenues. We're starting to see a little upward movement in coal prices. However, the recovery is relying on the post-pandemic recovery in the Asian region. Our view remains that the mid to long-term outlook is healthy, as the need for industrial and domestic electricity generation remains strong based on the future of growth in Asia, New Hope's key export market. And recent events have reinforced the importance of low-cost operations. New Hope generated an operating cash surplus of $300 million, even in a challenging year. As I said earlier, the cash generation from assets last year was $500 million, so when coal prices normalise, New Hope will be able to quickly pay down debt and generate strong cash for shareholders. Both Bengalla and New Auckland are in the lowest cost quartile of global coal production. At current coal prices, a lot of global production is unprofitable, and we should see some supply responses with shutdowns or early exits from some high-cost mines. At normalised coal prices, New Hope's assets are highly cash generative. These long-life, low-cost assets producing quality coal will be resilient throughout the cycle and changes in demand dynamics. The values of listed investments in the portfolio reduced due to the market disruption of COVID-19. Over the year, the portfolio was down 12%, which is roughly in line with the market. Dividends received were, however, in line with the previous year, which is a good result. While a further investment was made in Ironbark Asset Management, none of the unlisted investments were revalued or written down. The total value of the portfolio continues to be well above its cost base. The pharmaceutical portfolio is made up of Australian Pharmaceutical Industries, API, Pala Pharma and Apex Healthcare Berhad, which is listed on the main board of Bursa Malaysia. WHSP received dividends of $5.6 million from the portfolio during the year, which was down on the $9 million we received the previous year, and this was because API did not pay an interim dividend this year at the height of the COVID-19 uncertainty. The pharmaceutical portfolio contributed $12.5 million to the group's regular profit after tax, which is slightly down on the previous year. Round Oak had a difficult first half with falling commodity prices, underperforming operations and high treatment charges for the zinc production at Jaguar. This caused us to reassess the carrying values of the assets at the end of the first half, which coincided with the low point in commodity price and the outlook. Losses persisted while the mines were in development phase. Since then, zinc and copper prices have recovered from the bottom of the market in March 2020, and in the last 6 months, copper has increased over 40% to over $3 a pound, and zinc is up over 30% to over $2,500 per tonne. Mining of Round Oak's three major assets, Mount Colin, Barbara and Jaguar, is proceeding to plan, and the recovery of commodity prices is very well timed, given the development capital for the mines has largely been spent and the ore will be produced and sold over the next couple of years. Exploration activities are focused on targets to increase the life of the current mining operations. Early results have been encouraging, and these programs will continue into FY21. In July 2020, contracts were exchanged to sell the shopping centre at High Street, Penrith, in which WHSP holds a 50.1% interest. Our share of the proceeds are expected to be $14 million, with settlement due in November 2020. That means that we will maintain ownership of two property assets directly, one at Pendant Hills and the industrial property at Castle Hill. And these assets are presently being repositioned with a blend of capital improvements and leasing initiatives to increase income and value. The private equity portfolio increased in value by $136 million during the year, finishing at $272 million. This increase was mainly due to new investments in agriculture. We were attracted to the agricultural investment because it's an uncorrelated asset class, and we were seeing opportunities arising out of recent free trade agreements for scalable agricultural production to generate good returns. We also think Australia is globally competitive in food production, and the food scarcity is a theme that interests us. The investments are geographically diverse with a number of different products across citrus, macadamias, avocados, stone fruit and table grapes. The remaining assets in the portfolio performed quite well, with the exception of Aquatic Achievers, which was obviously impacted short term by the shutdown of its swim schools. But most of those schools are now operational. Control continues to benefit from infrastructure and resource spending, and Dimeo has seen continued demand for commercial cleaning. And finally, WHSP has over $500 million invested across Australian equity strategies. The WHSP Large Caps portfolio is externally managed by Contact Asset Management, the strategy aims to deliver capital growth and a yield that exceeds the market through the cycle. The large cap portfolio outperformed the relevant index over the year by 1.9%. And WHSP's small cap portfolio is our allocation of capital to earlier stage, higher growth companies. This portfolio aims to find companies that can grow into a bigger part of our portfolio. And for the 12 months to 31 July, the small cap portfolio generated an investment return of 4.4%, which is 12.9% more than the relevant index. Thank you very much for listening, and we'll be happy to take questions.
Okay, the first question is from Raju Ahmed from CCZ. This was for Brickworks. With current unemployment rates and net immigration, what is your confidence on housing approvals going into financial year 22 and 23 versus current supportive first home buyer conditions? And what is the likely pent-up Australian new housing demand flowing on from the hard stop caused by the prior Banking Royal Commission?
Thank you, Raju. It's great to see you asking the first question again today. The first thing about immigration, when people immigrate to Australia, it takes about 3 to 5 years before they buy their first house. So I don't think we'll really feel the effects of the low immigration for the next year or so, but eventually it will start to have impact. And that's why it's so important that the government gets immigration and students coming back into Australia. Anybody who's going to come here for one of those two purposes is more than happy to spend 2 weeks in quarantine, and we need to increase the amount of quarantine so we can get those people coming back into Australia. Without that, it's going to significantly hold up the rate that the economy picks up. In regards to the unemployment, the pandemic has impacted some specific sectors. People, waitresses, etc., who worked in restaurants, people who worked in tourism. These people, unfortunately, weren't often full-time and weren't often high-income earners, and so therefore they're more in the rental market, is my feeling, than they were in buying properties. Might be a bit different in the regional areas where properties are cheaper, but in the major cities, and this is why we have a high rental vacancy in apartment buildings, because a lot of those people working in restaurants, as you know, were young people from overseas that are just on a working holiday around Australia. So I think it'll have marginal impact. Any builder on the East Coast, particularly in Sydney and Melbourne, will tell you that the main demographic that's buying homes in Australia today is of Indian background or heritage, and they're more likely to be someone who's working in IT or medicine and have well-paid jobs. And so I think we'll find that will continue for the time being, as long as we fix up that immigration.
Okay, the next question again from Raju. How should we think about the step change underlying EBIT margin expansion run rate in building products North America over the next 2 to 3 years?
Well, clearly there's some things there we're not really going to know about how the sales are going to go with the interruption of COVID and how that pans out. I mean, if we knew that there was a vaccine, definitely available and those building sites were going to get going, I think we could see we'd ramp up and we'll get our sales up more where they should be, which is about another 20 or 25% above where we are at the moment. We're really running at the level we were last year. So we need to see the construction industry in the cities open up again. And because in that area, that non-residential area is the area where we get the highest margin. It's good to see residential housing picking up, but it doesn't have the margin that we get in that non-residential area.
Okay, and there's a few questions relating to this next topic. Is further cap rate compression realistic, noting the accelerating shift to e-commerce and resulting likely increasing demand for industrial warehousing type property assets?
Yeah, well, you would have heard me talk every year. I say I don't think it'd go any further, and every year I'm wrong. Look, I think what we're going to see though, there's a lot of factors that go into what the cap rate is. It's not just cheap money or chasing these sort of returns. It's also what the rent is. What's the competition from other areas? And I think what we might see going forward is more industrial land become available in that corridor between where we are and the new Badgerys Creek Airport, and that will obviously bring more competition to the market. So that might as much hold the rent, the rent per square metre down. And so how they work out, it's a bit hard to call, but nobody would have predicted where we are today, and it's one of those things that's very hard to predict what the future will be.
This question is for Todd, from David Walker from Pring Dean Family Office. Todd, in the past, Sol saw financial services as a likely sector for acquisitions by the company. Is this still your view, or are you now looking at other sectors?
Well, we were always looking at a number of sectors, and financial services was one that we saw had the appropriate tailwinds demographically to support it, and we think that those things are still true today. The continued momentum in growth in superannuation that needs to be invested will drive the individual size of each person's portfolios as they get older. And as portfolio of superannuation individual portfolios increase, their need to be advised appropriately also increases, and the cost of that advice on a relative basis comes down because the portfolio is growing. So we think that there's a really good, bright future for good quality financial advice, and it's something that we're continuing to invest in. But it's never been the only thing that we're looking at, and now with the dislocation that we're seeing, there's a lot more industries and opportunities coming at us.
Thanks, Todd. The next lot of questions, I think, are for Lindsay. So the first one is from Brooke Campbell-Crawford from JP Morgan. On Australian building products, I note on slide 37 that orders and sales increased in September across most businesses. Can you confirm if this is an increase versus September 19 or increase versus recent months? Also some colour on how this growth varies by business unit.
Okay, well, first of all, the last bit first. It's been pretty universal, of course. Bricks, masonry and roof tiles, they've all been strong, and we've seen increased orders in precast, so it's across the whole group. Our sales are running at approximately the same rate as what they were running 12 months prior. However, the orders have taken a significant jump above what we would think would be the normal cancellation rate. And this is basically the leading orders coming in from the government stimulus is what it is. And so we would anticipate that this level of orders will continue for the next, for the next period at least. The bit that I can't give you vision on is how much has particularly Victoria been impacted by this second close down, and has that put a hole or a pothole in the builders' pipeline of construction because people haven't been able to sign their contracts and go visit those display homes. But basically the rest of Australia is open for business, even if we can't move around. And the stimulus, as I mentioned to some other people earlier today, I mean, you've got 25,000 from the government. Some states are giving 20,000. Individual and their partner can take $20,000 each out of their super. The builders are offering some pretty big cashbacks, so you can basically walk in to a builder if you take advantage of all those with over $100,000 deposit, which is, there's never been a better time to buy a home. I think that once the people can get out of their houses and go see the builders, they'll be knocked down in the rush, to be honest.
Thanks, Lindsay. The next one is from Andrew Donlan from CLSA. The feedback in Australia suggests the pipeline is building. Can you give us an idea of how long the pipeline is? And given you've reinitiated the capital projects in Australia, should we assume we are close to the bottom in terms of New South Wales Vic volumes?
Yeah, the pipeline, I think, is for the balance of this financial year, so 9 months is what we're seeing at the moment. The second half of next year, I think the jury's out until we see what happens with that immigration and, do we get out of this? Do we get a vaccine? We don't know the answer to any of those questions. And sorry, the second part of the question was, Lisa?
Given you have reinitiated
the capital
project.
Yeah. Yes, look, we had a lot of reasons why we wanted to do those capital works. We had to get off the masonry plant, we had to get off the site, and so that's a real crash construction, and it's roaring ahead very quickly. And we haven't spent any serious money in New South Wales in really 30 years, and we got to the point where we really needed to refit some of those plants. But The outcome of that, of course, is we're going to concentrate our production on the eastern side of the Horsley Park Walgrove site, which will hopefully then down the track release some more land on Oakdale East.
Final question from Andrew from CLSA. With $1 million worth of property revals in the second half, should we assume we're pretty much done for revaluation gains?
Yeah, that's a bit similar to the first. Look, what happened, we follow Goodman's strategy on the revaluations, and their policy is that if it moves more than two notches, in other words, 50 points, they revalue. And what that did, that brought forward all the revaluations, which were otherwise spread out throughout the year, into the first half. That's the reason. It's got nothing to do whether or not cap rates go down further or not. And I think I answered the cap rate question a bit earlier.
What proportion of Building Products Australia revenue is derived? Oh, I think I covered that. Derived from New South Wales and Vic. Yep.
Most probably 60%, 65%.
Question for Todd. Can you please give us some details on your aged care developments? That's from Paul Shepherd from Morgan Financial.
At the moment, we've entered into a relationship with Prevectus Healthcare, which is run by Shane Moran, to develop retirement living developments that are at the higher end, good quality luxury style developments for over 55s. We have just recently, I think in the last couple of weeks, lodged our DA for our first development across the road from the beach in Cronulla. It will be a very good quality development of about 40 units. We're certainly looking for more opportunities to expand our portfolio.
Thanks, Todd. There's another question for you from Steve Sassine from Morgans. Given the drawdown on bank funding facilities during the year to take advantage of potential investment opportunities, which sectors are you anticipating these opportunities to arise in?
Well, our investment style is to be opportunistic, and so it's difficult to break it down and say which sectors individually we're looking at. But from a thematic perspective, we like investments that come from industries that are benefiting from demographic tailwinds, regulatory improvement, technological change. And, if we look at things like financial services, which I mentioned, healthcare, obviously, with the ageing population, tourism has always been a strong sector for Australia. And some of those sectors have been impacted by what's happening recently with COVID-19 and may present some opportunities for us. But it's difficult to narrow it down by sector because it really depends on what opportunity we see, and quite often we see opportunities that are outside our targeted sector, and they are something that we pursue aggressively. So I guess we're open to anything.
Thanks, Todd. Back to Lindsay now. Can you remind us what the total capital invested in Southern Cross Cement was, what the current and targeted volumes are for the import terminal, and what EBIT is being generated per tonne of volume?
No. I did the first question. I'm not sure, Robert, did we ever announce what we spent on the terminal? It's circa 60 million it cost. Yeah, nothing beyond that. So the other question, I can't tell you the margin, I can't tell you that. But look, I'll tell you something, I can tell you what's happening in the international cement prices, and that's they're going down. And of course the Australian dollar's been firming, so this has been dropping. Every ship we've brought in is based, the landed cost in the silo has been below the previous one. So as the operation becomes more reliable and we get those ships unloaded quicker, the cost of the cement in our tanks is cheaper. And if anything, we've had to accelerate the ships as they come around Cape York to try and pick up some time so we get them in before we run out. So we're very happy about how that's been going. Is there any more questions? Or we?
There were a few more questions, but I think everything has been covered in
Okay, all right.
in
If
your
anyone
answers.
got any other questions, I'm more than happy if you email myself or Robert, and to ask them. All right, well, do you want to close? Close. All right, okay, well, thank you, ladies and gentlemen, for joining us today. I hope you enjoyed it. I hope you found that worthwhile. We look forward to seeing you as we do our rounds. So thank you very much and all the best. Thank you.